Hey there! If you're scrolling through videos and stumbled on this one because you're curious about investing but feel completely overwhelmed, like you have no idea what the stock market, ETFs, or any of that means, this video is perfect for you. Whether you're a high schooler thinking about growing your money beyond a simple piggy bank or just someone frustrated with those tiny interest rates on savings accounts, I've got you covered. Don't stress. I'll explain everything in super simple terms, like we're just chatting over snacks. No overwhelming jargon, I promise. We'll start with a glossary of key terms, cover the basics of the stock market, and explore whether investing and diversification align with biblical principles, including if investing is like gambling. Then, we'll dive into what ESGV is, its pros and cons, expense ratio, risks and returns, how buying ESGV differs from a savings account, and where to find more info on ESGV fund literature. Before we delve into the details, here's a quick glossary of some key terms you'll see in this explanation, and in investing in general. I'll define them simply to make everything easier to follow. Don't worry if you don't understand these terms right away. We'll use them later with examples to help you grasp them better. Brokerage account. An online account you open with a company like Vanguard, Schwab, or Fidelity to buy and sell investments like stocks or ETFs. It's like a bank account, but for investing. Compounding. When your investment earnings, like gains from stocks, start earning money themselves over time, helping your money grow faster, like a snowball getting bigger as it rolls. Custodial account. A special brokerage account that a parent or guardian opens and manages for someone under 18. The money belongs to the minor, but an adult oversees it until they turn 18, or 21 in some places. Diversification. Spreading your money across many different investments, like stocks in various companies, to reduce risk. If one goes down, others might go up. Dollar cost averaging. A strategy where you invest a fixed amount of money at regular intervals, like monthly, regardless of the market price. This way, you buy more shares when prices are low and fewer when they're high, averaging out your costs over time. ESG, environmental, social, and governance. A way to judge companies based on how they handle the environment, for example, pollution. Social issues, such as worker rights, and governance, like honest leadership. ESGV uses this to pick ESG-aligned companies. ETF, exchange-traded fund. A bundle of stocks or other investments that you can buy and sell like a single stock. It's like a pre-made basket of investments. Expense ratio, the annual fee as a percentage that an ETF charges for managing it. Lower is better because it means more of your money stays invested. Index, a list of stocks that represents part of the market, like the S&P 500 for big US companies. ETFs like ESGV track an index, meaning they try to match its performance. Market timing, trying to predict the best times to buy or sell investments based on market trends or conditions. It's risky because markets are hard to predict accurately. Paralysis by analysis, overthinking or analyzing something so much that you end up doing nothing, like waiting forever for the perfect time to invest instead of getting started. Prospectus, an official document from the fund company, like Vanguard, that explains how an ETF works, its risks, fees, and goals. There's a short summary version and a full one. Returns, how much your investment grows or shrinks over time, usually shown as a percentage. 10% return means $100 grows to $110. Risks, the chance that your investment could lose value. In stocks or ETFs, risks include market drops, company failures, or economic events. Savings account, a bank account where your money earns a small amount of interest and is super safe, insured by the government, but it grows slowly. Shares, tiny ownership pieces of a company or ETF that you can buy. Owning shares means you own a slice of whatever the company or fund holds. Stocks, ownership shares in a company. When the company does well, stock prices usually go up. If not, they go down. Now that we've got the lingo covered, let's jump into the basics of the stock market. Imagine the stock market as a huge online marketplace where people buy and sell tiny pieces of companies, called stocks or shares. If you buy a stock in a company like Apple, you're basically owning a small part of Apple. The price of these stocks goes up and down based on how well the company is doing, what people think about the future, and big world events. Most people don't buy individual stocks because it's risky. If one company messes up, you could lose a lot. Instead, many invest in something called an ETF, Exchange Traded Fund. An ETF is like a big basket that holds hundreds or thousands of stocks from different companies. It's easier and safer because it spreads your money around. This is called diversification. You can buy shares of an ETF just like a stock, and it trades on the stock market. Let's tackle another common question. Is investing in the stock market biblical, or is it basically gambling? The Bible doesn't mention the stock market directly, since it didn't exist back then, but it does give principles on money management that can apply. From a Christian perspective, investing can be seen as wise stewardship, using what God gives you responsibly to provide for your family, support the church, and help others. For example, in Proverbs 31:16, it talks about a wise woman who goes to inspect a field and buys it. With her earnings, she plants a vineyard, which is like making thoughtful investments for future growth. Jesus' parable of the talents in Matthew 25 praises servants who invest their master's money to make more, rather than burying it out of fear. It's about being faithful with resources, not hoarding or wasting them. The key is balance. Invest with generosity, thankfulness, and without greed or idolatry. Like in 1 Timothy 6 verses 17 to 19, warning against trusting in wealth. If done wisely, long-term, diversified, and aligned with your values, it's not forbidden. It's encouraged as part of prudent planning. Now, is it gambling? Not really, though some see similarities because both involve risk and potential loss. Gambling is typically pure chance, like a lottery or casino game, where most people lose so one can win, and it's often driven by get-rich-quick hopes without work or ownership. Proverbs 13:11 says, "Wealth from get-rich-quick schemes quickly disappears. Wealth from hard work grows over time." Investing is not a get-rich-quick scheme. It is about knowledge, research, and owning parts of real businesses that produce value. Everyone can potentially win if companies grow. The stock market was designed to lower risk by pooling resources, not heighten it like gambling. That said, day trading or speculating, betting on short-term price swings without research, can blur into gambling territory and might conflict with biblical warnings against greed or foolish risks. Like in Proverbs 28:20, that says, "The trustworthy person will get a rich reward, but a person who wants quick riches will get into trouble." So, long-term investing? Generally prudent and biblical. Gambling-style trading? Probably best to avoid. Ultimately, pray about it and align with your convictions. It's about honoring God with your finances. You might be wondering if this whole idea of diversification, spreading your investments to manage risk, has any roots in ancient wisdom. Turns out, the Bible touches on concepts that align surprisingly well with it. In Ecclesiastes 11:1-6, there's a passage titled "The Uncertainties of Life" that offers practical advice on dealing with uncertainty, often interpreted today as encouragement to diversify rather than putting all your eggs in one basket. Let's break it down verse by verse and relate it to diversification in investing. Verse 1. Send your grain across the seas, and in time, profits will flow back to you. This is like taking calculated risks by sending out your resources. Think, investing in stocks or ETFs like ESGV into uncertain waters. The return might not come right away, but diversifying means you're not keeping everything at home. You're spreading it out for potential future gains, even if it takes time. Verse 2. But divide your investments among many places, for you do not know what risks might lie ahead. This is the clearest nod to diversification. It directly advises splitting your investments across multiple places, like different stocks, sectors, or funds, because you can't predict risks, market crashes, economic downturns, or company failures. By not putting everything in one place, you protect yourself if one area tanks. Verse 3. When clouds are heavy, the rains come down. Whether a tree falls north or south, it stays where it falls. Here it's about accepting that some things are inevitable and out of your control, like weather events or random market shifts, recessions. Diversification helps because if one tree, investment, falls in a bad direction, your others can still stand strong. Verse 4. Farmers who wait for perfect weather never plant. If they watch every cloud, they never harvest. This warns against paralysis by analysis. Don't wait for perfect market conditions, no clouds of uncertainty, to invest. In diversification terms, start spreading your investments now instead of trying to time the market, or you'll miss out on growth opportunities. Verse 5. Just as you cannot understand the path of the wind or the mystery of a tiny baby growing in its mother's womb, so you cannot understand the activity of God, who does all things. Life and markets are full of mysteries we can't fully predict or control. Diversification acknowledges this humility. By spreading your investments, you're not pretending to know the future. You're preparing for whatever comes. Nobody knows for sure which company is going to do well. Verse 6. Plant your seed in the morning and keep busy all afternoon, for you don't know if profit will come from one activity or another. Or maybe both. Keep investing consistently, that's the morning and afternoon across different areas, because you don't know what will thrive. This is like dollar cost averaging into a diversified ETF, like ESGV, regularly adding money without knowing which parts will perform best, but increasing your chances overall. An example of this would be investing by buying one share of ESGV per week. While this is not direct financial advice from the Bible, it is timeless wisdom that supports the idea of diversification as a smart, prudent approach to uncertainty. Pretty cool how ancient words can apply to modern investing, right? With that biblical foundation in mind, let's look at a specific investment option that aligns with ethical values. ESGV. ESGV is a specific ETF run by a company called Vanguard. Its full name is the Vanguard ESGUS Stock ETF. The ESG part stands for Environmental, Social, and Governance, fancy words for investing in companies that meet certain ethical standards. Environmental. Companies that minimize pollution, use clean energy, or help fight climate change. Social. Companies that treat workers fairly, support diversity, and avoid harmful industries like weapons or tobacco. Governance. Companies that are run honestly, with transparent leaders who avoid unethical practices. ESGV focuses on U.S. companies, like Microsoft, Apple, and NVIDIA as its top holdings, that score high on these ESG rules. It tracks an index, a list, called the FTSE US All Cap Choice Index, which includes about 1,333 big, medium, and small U.S. companies that meet ESG standards. Basically, it's a way to invest in the stock market while supporting ESG-aligned companies and avoiding non-ESG-aligned ones, like those heavily involved in fossil fuels, though ESGV still has a tiny bit of exposure, about 0.37%. It also excludes industries like adult entertainment, alcohol, tobacco, cannabis, gambling, weapons, or nuclear power. As a Christian, I personally don't want to invest in companies related to adult entertainment, alcohol, tobacco, cannabis, or gambling. These are my convictions, though we all have different ones. There are some companies that are not part of ESGV. For example, as of July 2025, Berkshire Hathaway is not part of ESGV. It's excluded due to its holdings in energy companies like Chevron and Occidental Petroleum, which are involved in fossil fuels. This doesn't make Berkshire Hathaway an inferior company. It's a strong performer run by Warren Buffett. But its investments don't align with ESGV's strict ESG rules. Like anything with money, there are upsides and downsides. These are based on how ESG ETFs, like ESGV, work in general. Pros: invest in alignment with your values. If you care about the planet, people, or ethical business and want to avoid industries like adult entertainment, alcohol, tobacco, cannabis, or gambling that conflict with biblical principles, this investment approach allows you to support companies that align with your faith without harming the environment or exploiting workers. It's like voting with your money. Diversification. It spreads your money across tons of companies, over 1,300 as of July 2025. So you're not betting everything on one stock. This can make it less risky than picking individual companies. Low costs. Vanguard is known for keeping fees super low, which means more of your money stays invested. We'll talk about expense ratio next. Potential for solid growth. Some believe ESG-aligned companies might do better long-term because they're more sustainable and less likely to face lawsuits or regulations. Historical returns have been decent. Cons. Missing out on big winners. This approach excludes non-ESG-aligned companies, such as oil giants or tobacco firms, which could lead to underperformance compared to broad market ETFs if those sectors surge. Since I'm not interested in investing in tobacco firms, I'm comfortable with that trade-off. It's a personal choice each investor must make. Not perfectly ESG-focused. There's debate about greenwashing, where companies seem ESG-aligned but aren't fully committed. ESGV still has a small amount of fossil fuel exposure. Could be more volatile in tough times. If the economy shifts away from ESG-aligned companies, or if ESG trends fade, it might not keep up with the broader market. Newer fund, ESGV, started in 2018, so it doesn't have as much long-term history as older ETFs, making it harder to predict. Expense ratio. This is like a yearly fee you pay to the company running the ETF, Vanguard, for managing it. Things like picking stocks and handling paperwork. It's a percentage of your investment. For ESGV, the expense ratio is 0.09%. That means if you invest $1,000, you pay about 90 cents a year. That's really low compared to other funds. The industry average is around 0.22%, which is a big pro, because low fees let your money grow more over time. Risks. Investing in ESGV, or any stock ETF, means your money can go down in value, sometimes a lot. The stock market is unpredictable. Things like recessions, wars, or company scandals can cause prices to drop. You could lose part of your original investment, especially in the short term. ESGV has extra risks because of its ESG focus. If non-ESG aligned companies surge, like during an energy crisis, it might lag behind. Also, since it's mostly tech-heavy, top holdings are tech giants. It could be hit hard if tech struggles. Unlike a savings account, there's no guarantee you'll get your money back. Returns. This is how much your investment grows or shrinks over time. Historically, the stock market averages about 7 to 10% per year over long periods, but it's bumpy. For ESGV specifically, recent returns, as of around mid-2025, show a year-to-date gain of about 8.18% and a one-year return of 14.71%. That's better than many savings accounts, but past performance doesn't guarantee the future. Over time, it could beat inflation and grow your money more than a savings account, but you might have years where it loses 20% or more. A savings account is super simple and safe. You give your money to a bank, they pay you a little interest, like 4 to 5% per year as of July 2025, depending on the bank. And your money is insured by the government up to $250,000. No risk of losing it. It's great for emergency cash or short-term goals because the value doesn't fluctuate. ESGV is an investment, not a savings tool. You're buying into companies, so your money can grow faster, potentially 7 to 10% or more annually over time. But it can also shrink if the market drops. It's for long-term goals, like saving for college, retirement, or donations to your church, where you can ride out the ups and downs. You need a brokerage account to buy it, like opening an online investing app. And it's not insured. If the market crashes, you could lose money. But the reward is higher growth potential, especially with compounding. Your gains earn more gains over years. In short, savings are safe but grow slowly. ESGV is riskier, but could make you way more money if you're patient. To get the most current and detailed info on ESGV, search for Vanguard ESGV Fund Literature or ESGV Prospectus on Google. This will point you to official Vanguard websites and downloadable PDFs with key documents. These are free and offer in-depth details straight from the source. Here's what kind of information you can typically find in the fund literature. Fact sheet. A quick 1 or 2 page summary updated quarterly, showing recent performance, top holdings, sector breakdowns, expense ratio, and basic risks. Great for a fast overview. Summary prospectus. A shorter, easier-to-read version of the full prospectus, covering the fund's investment objectives, main risks, fees, past performance, and how it works. Perfect if you want the essentials without too much detail. Statutory prospectus. The full, detailed legal document explaining the fund's strategy, ESG screening process, complete risks, management team, fees, and historical data. Required reading for serious investors, often 20-plus pages. Statement of Additional Information, SAI. Extra in-depth info not in the prospectus, like board member bios, investment policies, tax details, and voting records, useful for digging deeper into operations. Annual report. Yearly update with audited financial statements, full portfolio holdings, manager's commentary on performance, and market insights. Helps you see how the fund did over the past year. Semi-annual report. Similar to the annual report, but for the first half of the year, including unaudited financials and holdings updates, provides mid-year snapshots. Investment profile. A brief outline of the fund's characteristics, like its benchmark index, asset allocation, and key stats, often similar to the fact sheet, but more focused on strategy. In summary, we've covered a lot today to get you started on your investing journey, from the key terms and basics of the stock market to exploring whether investing and diversification align with biblical principles, including addressing if it's like gambling, and then focusing on ESGV itself, what it is, its pros and cons, expense ratio, risks and returns, how it compares to a savings account, and where to find more detailed fund literature. ESGV stands out as a great entry point into the stock market for those who want to grow their money over time while aligning with positive environmental, social, and governance values, offering diversification, low costs, and potential for decent returns, though with some unique risks tied to its ESG focus. If you're nervous about getting started, and a lot of people are, since opening a brokerage account and buying ETFs aren't things most folks learn in school, remember that movies often make investing seem like a high-stakes, complicated game. But in real life, it's far simpler with user-friendly apps and websites. Start small, like buying just 1 share of ESGV to dip your toes in and build confidence. If you're at least 18 years old, check out my video, How to Open a Vanguard Account, your step-by-step video guide for easy instructions. If you're under 18, you'll need a parent or guardian to help you open a custodial account. This information is for educational purposes only and is not financial advice. Investing involves risks, including the possible loss of principal. Past performance is no guarantee of future results. Always do your own research or consult a qualified financial advisor before making any investment decisions. If you found this video helpful, please hit the subscribe button, like it, and turn on notifications so you don't miss future tips on investing and personal finance.